Today's guest needs no introduction. He's been in the finance space for decades. He started out as a rocket scientist working for the aerospace industry. Throughout his career, he wore many hats, including research and advisor for commercial banks, head of trading, portfolio manager, senior quantitative analyst, consultant for investment firms. He authored many books, with some of them translated into many languages, and some of them actually are considered a Bible for algo traders. His latest book is Kaufman Construct Trading Systems, which I read cover to cover, and it's really valuable for any trader. So without further ado, let's meet my guest today, Mr. Perry Kaufman. Thank you very much, Perry, for joining me on this interview. It seems like only 3 weeks ago where I read your great book, Kaufman Constructs Trading System, and you already launched a new book. Would you say this book is a continuation of this one, or is just a new one? Is it for beginners, for advanced?
Well, it's not exactly yesterday that I put that. These things take, it took 2 years to write it. So, and there it is. And you'll notice that it's been discounted by Amazon. I was thinking myself of buying one. So, maybe I'll learn something from it. But
Yeah,
anyway,
it's a great deal.
it's intended to help people who are getting started trading, but it moves through pretty quickly to intermediate and risk control and other things that a not an extremely sophisticated, but most traders will find lots of things of value in different parts of the book. And I add my own thoughts here and there, and hopefully that's interesting information for most traders.
I'm sure it would be a great book to get and add to your collection of books. They're all filled with gems and great information. Looking forward to get that one.
Yes, well, I hope so. It also comes with, an appendix with spreadsheets and programs so that it helps traders along, just like the previous book, the Kaufman Constructs. So hopefully
And
that's a
we
help.
and I just learned that it is in color, so that's an
Oh, it's in
additional
color. Yeah.
benefit. So that's
Well, we become more modern as time goes on. So
true.
uh, I think the color helps. I got tired of trying to distinguish between the gray line and the not so gray line on the charts. It's much easier to see it in color.
Yeah, but you do actually, in the old book, you do actually mention like the thick line is this. So you try to distinguish even though it's not in color. So I think it's good anyway.
It's the way we did it for years and years.
In most of your books, you have this concept of loose pants. And would you please elaborate on this concept for the people who doesn't know it?
Is really a very important concept. It really means that it's an argument against overfitting. Loose pants means you have as few rules as possible, and you need to accept the risk and the variation that goes along with that, because it will account for situations that you haven't seen before. When you overfit something, or when you try to fit something carefully and you specify a particular profit taking level or stop, you find that in the future, those numbers don't mean anything, that the market doesn't repeat the way it had in the past. And the only way you can succeed is to generalize the rules. And you can do it by testing a profit level across a lot of different markets. And you make the profit level based on volatility, so it self-adjusts. And I find that in general, for example, a profit level of 3.5 ATRs for intraday trading works, or for short-term trading in general, works very well across most markets. You could try to make that bigger or smaller for specific markets, But I think you'll find you'll be disappointed in the long run that it really doesn't improve anything, that you're hoping that the market in the future will be exactly the same as the market in the past. Just doesn't happen that way. So generalizing is your best approach to most of the parameters, most of the rules you have in your system.
Okay. You also, when you build systems, I noticed that you try to build iterations. So, for example, the trend following system you mentioned in your book, instead of picking the best parameter, let's say 100 days, you build 60, 100, 140, and you combine all these systems in a portfolio. Would you say it's if we pick the median out of these numbers, will yield the same result as the portfolio? So just in case, if somebody they don't have the capital to trade multiple systems, would you say the median will yield the same result?
I don't think so. Unless the median's in the right place. If you were going to pick one trend speed, because that's all you could do, I would probably pick 80 days. I think 80 days is kind of the middle range of where the macro trend falls. And so that would be kind of your benchmark example. I wouldn't make it shorter than that. Somewhere between 60 and 120 would be all acceptable. I pick 80. I think it's still inferior to picking 3 periods. One of the concepts you have to think about, if you test a system and you can use some sort of an optimizer that tells you the results of all of the trend speeds from, say, 40 to 120, and you look at that result and you see that they're all profitable, which means the system that you're using is robust. They're all profitable, or most of them are profitable, but to different degrees. So picking the best one is going to be the one that happened to be fortunate enough to miss some drawdown or benefit from some price shock that won't likely will happen in the future. So what I do is I really want the average result of all those tests. And that's my target. And I think that's the most realistic goal for traders, is to look at all the results you've tested, get the average of that, and that's what you'll probably get. You won't get the best, you won't get the worst, you'll get the average. Now, to try to get the average in real trading, you need to pick a few of those parameters. And I always suggested, say, 30, 60, 120 for a moving average, or 40, 80, 120. Spread those numbers out. Be careful that you don't pick two that are very long, because the percentage difference between a 30 and a 40-day moving average is much bigger than the difference between a 100 and a 110-day moving average. So, if you're picking longer term, you have to make the distance between those two choices much bigger in order to get diversification. So that's the concept. The concept is you're trying to get the average return of all of your tests, which means that you need to pick a market and a system that has positive results across virtually all of your tests. And the one that satisfies that the most is a trend. So that's why I'm very keen on trends, even though I do have short-term programs, and some of them are quite nice. Short-term programs benefit from noise. And so the concept is quite different. You're doing almost the opposite of the trend, and they can work well too, and they're good for diversification. Now I think I've babbled on a bit more than I planned to.
You are correct. In fact, you mentioned the percentage differences, and I don't know why, at least retail packages, they are still, when you optimize, they increase by, for example, moving average increase by, look back period, and they don't go by percentage. I mean, we are in
Yes.
2022, but they're still, nobody is doing percentage, which of course makes total sense. Like just like you mentioned, 30 and 60 is double, but then 100 and 130 is 30%.
Yes, it's
So
true. People don't think about it when they look at this test result. They see erratic returns on the faster end of the test and very consistent returns on the slow end of the test. They don't realize that they're not looking at the same thing, that those consistent returns on the far end of the long test is because they're not changing much. They're very
yeah,
similar results. And you need to know that in order to decide how to select 2 or 3 different test periods that will help you diversify your returns.
true. Mostly you're futures trader, and with futures, for people they don't know, they expire sometimes monthly, sometimes every 3 months, and we need, of course, to connect all these expiring futures to get like one continuous
Yes.
series. And there are many ways to stitch these future contracts together. What do you think is the best way to stitch, or do we have an option to choose between data providers of different stitching methods?
Yeah, most of the data providers do give you some choices as to how you connect these future series. I I usually do it by open interest because it tells you when the traders move their positions from one delivery to the next. So I think open interest is the best. You can do it a combination of volume and open interest, which is an option that some of the vendors allow. And in some cases, I specifically say, like for the S&P, that I want to roll 3 days before expiration, which it tends to be on a Friday in the middle of the month. For interest rates, I want to roll 3 to 5 days before the end of the month prior to delivery, because into delivery, the margin requirements go up tremendously. And also in the last couple of days before delivery, all the big funds are rolling. And so I'd like to be a little bit ahead of that. But you'll get experience doing it, but the default is probably some combination of volume and open interest. If you can only do one, I do open interest.
Okay. And also from that point of view, when we stitch these contracts together, of course, they get back adjusted. So, if we, for example, if we look at crude oil in 2008, it's totally different than the real price of crude oil in 2008. The cash index, on the other hand, reflect that price precisely. So, in back testing, why don't we use the cash index instead of this stitched contract?
It is a good question. Um, Unfortunately, we're not trading cash, and cash can be quite different from futures. And so, especially in grains, I know that people don't trade much grain anymore. I used to be very immersed in it years ago. But, in corn, for example, during the summer, we're trading the December delivery, which is the new crop, which will be harvested in October, mostly in October, late September, October. But the cash is reflecting last year's crop, and it is influenced by export demand and general consumption. So those prices are tremendously different. They do come together at delivery. Whatever's left over in the previous year in storage will take on the price of the new crop. So they come together. But before that, they can be extremely far apart. And that's the same with crude oil. It's the same with most markets. The cash market does not have anticipation built into it. It is what people are buying and using right now. And the futures market is a different dynamic and can be quite quite different from the cash market. Anyway, because we trade the futures market, you should be looking at futures market data and put together for those months that you will be trading that market. Uh, it is the only sensible thing to do.
Okay. In your book, you used volatility as an exit, which is actually, I only know you use that principle. So, to give an example, if you're trend following on Tesla, Tesla shoots to the moon, you found out from your own research, as you said, that exiting on extreme volatile levels, it's good. My question is, when let's say you are in Tesla, it gets really volatile, you exit. When do you get back in? Do you wait for a new signal on that trend following system, or you just get back in when the volatility goes below a certain level?
Well, okay, volatility is really important, and your question is really important, but I have to answer different parts of it.
Okay.
So, for example, with Tesla, um, first, stocks and futures and portfolios all have different levels of volatility based on their diversification. So, stocks will have the most volatility because a single stock is clearly not diversified. Tesla is one of those markets that is very volatile or has been very volatile. And my study of Tesla said that when it gets above 90 to 100%, based on a 20-day annualized volatility. Now you can look that up online and figure out the formula for that. But using 20 days means that the volatility can get even over 100% because you take 20 days and you extrapolate it to a year, so it can be more than 100%.
Yeah.
In reality, nothing can be more than 100%. But so I exit when Tesla volatility, the 20-day volatility, gets above, say, 90%. And at that point, my own work and my own belief is that the risk is greater than the reward. In other words, if you stay with it, you might make a little money, but the risk of holding on to it is going to be much greater than what you'll make. And so I get out of it. Now, when do I get back in? If I'm in a long-term trend following system, I get back in when it falls below that number. Now, you can set your own parameter. Maybe you want to get back in when it falls below 80 or 70%. Tesla tends to be fairly volatile in general. If you're in a short-term trading program and you look at the history of the volatility and you get out, then you wait for a new signal because you're not holding the trade very long anyway. In trend following, you can't afford to miss what we call the fat tail. And the fat tail is, those very, very long profits where you hold interest rate futures for 2 years and you make a fortune. If you were to take profits too soon on that, you might miss that gigantic move, which is important for your long-term returns. So, if I can summarize that,
Yeah.
For trend following, you need to look at each market that you're trading and decide what the historic volatility is, because volatility is very personal to different stocks and different ETFs and portfolios. So,
True.
as an example, while I may get out of Tesla at 90%, I would get out of SPY, the S&P ETF, at about 45%. And I would get out of a diversified trend portfolio at about 30%. So the more diversification you have, the lower the volatility will be, and the lower your volatility level should be for exiting. But getting back in, you can just wait to see that the volatility is declining and stabilizing, and then get back in. You do want to get back in unless you're in a short-term system.
Yeah, that's a great tip. actually for to add it to a portfolio to lower your volatility in general. And
Oh,
I
yes,
actually tested this on some system, and it is true, of course, what you're saying, that it is volatility is like schizophrenic. It's like some
yes,
stocks like 90 and some at 30, and
yes. They have their own personality.
yeah, they do.
So
Most future markets switched to electronic trading in 2008, and at least from my testing, I don't know how valuable is that. It shows that, for example, the breakout changed a little bit, so we can say that the structure of the market changed. Would you say then pre 2008 data is not as valid anymore, at least for short trading systems, or would you always include as much data as possible, even in short trading systems?
yeah, again, it's a good question because I think most people believe that older data is unimportant. And things change. For example, the euro in particular was the Deutschmark. So you want to say to yourself, why would I include older data that's the Deutschmark when it's now the euro? Maybe they're completely different things. But my philosophy is you need to seek out as much data as possible to get as many different patterns as you can because markets change. Just as an example, what if you had included in 2019 when the market had been going straight up from 2011, you had 8 years of incredibly consistent bull markets. What if you said, okay, I'll only test those 8 years because that's the market we're in? And then all of a sudden in 2020 and 2021, everything changed. And your system was still tuned to a market that was trending up only. I think your system no longer reflects the ability to deal with different situations. And the unfortunate thing is when you include longer amounts of data, the performance doesn't look as good. Um, it has bigger drawdowns. Maybe it doesn't have the returns that a shorter period would have, but that's reality. That's really what the market's going to do, and it's better to be realistic about it and then be pleasantly surprised that your system did even better than to be unhappy that your system had no way of coping with a market that wasn't in your sample data. So I would go back as far as possible in these tests and view those results as more realistic.
Yeah, makes sense. You use daily returns of the system in your calculations in the book, and my question is, if you are in a position in a system, then that P&L will change daily. So is that what you mean by daily returns of the system, or is just the closing PL at the end of each trade?
Oh no, you know, we have the advantage these days of spreadsheets and trading platforms that show you your profits and losses every day. I use this mark to market every day to post my returns, so that when I'm calculating volatility of my portfolio and I'm looking to see what my risk is, I have a record every day of my percentage return based on my total investment. So, I don't use margin and I don't use what might have been. I just post every day my returns, and then I calculate the 20-day annualized volatility of my portfolio to decide whether my risk is too high. And going at that towards the end of this new book, and maybe even in Kaufman Constructs, I talk about something called volatility stabilization. And that means when you do your testing and you set up your portfolio, you calculate what the volatility, historic volatility of your portfolio would have been. And the best thing to do is to adjust that volatility to 12%, which means one standard deviation of the volatility of your portfolio should be 12%. And if it comes out higher, then you have to trade smaller positions to bring it down to 12%. And if it's lower, you trade larger positions to bring it up to 12%. So that's how you start out. You target a volatility. If you're conservative, it could be 8%. If you're very aggressive, it could be 14%. I would suggest nobody go above 14% because the risk is very high. So now you start out with 12%, and then you track your actual performance in returns every day. And at some point, if the market's going with you and you're making money, it goes up from 12%, say, to 16%. At that point, I pull it back by reducing the size of my positions so that the volatility goes back from 16% to 12% by simply reducing my positions across the board. That means that I'm not letting risk get out of control. I've seen people that start with 12% and the risk goes to 21% or 23% in a very volatile market. At that point, if the market turns against them, they can be wiped out in 2 days. So you need to keep control. Now, even more important is when the volatility drops, because most of the money in trend following is made in low volatility situations. So the market's trending up nice and quietly as it did between 2010 2020, and the volatility has dropped to 8% or 7% or 6%. You are now making half of what you expected to make when you targeted 12%. So you need to double or bring your positions back up so the volatility is 12%. That's where the money will be made, by raising your volatility. Now, it's going to be much easier in stocks than in futures because adding a futures position is costly, but adding some shares of stocks are not. So you can do it, and you should keep it in mind wherever possible to manage this volatility. And you can read about it in the book under the portfolio management sections.
Yeah, and would that apply to short trading systems also? Like basically it's applied to any portfolio. It doesn't have to be long-term trend following.
Yeah, it's a volatility issue, short-term, long-term. If the volatility of returns goes up to 20%, you're in trouble.
Yeah.
So it's the volatility of the returns of whatever system you're trading.
Yeah, we've all seen our share of crashes, and I'm sure you've seen more. Recently, we had flash crashes where, like intraday, the market drops, I don't know, 400, 500, 600 points. How do you prepare for such thing? Is there any way to prepare for those crashes, especially if you, just like you said, like, let's say 4 ATRs, let's say it's a good level to put a stop loss there. Of course, all these will be hit in any flash crash. How do you deal with flash crashes? How do you prepare for them?
Well, if first, some of the flash crashes are only intraday, fortunately. And by time of the end of the day, if you happen to be having lunch, you might have missed it, and you're okay. In general, markets drop much faster than they rise. There's a vacuum because most traders, especially in stocks, are long. Floor traders, or what we used to call floor traders or professional traders or market makers, like to be short. My wife is a professional trader. She likes to be short all the time because that's where the money's made very fast. She can be in and out in one day and make money. I'm on the other side of that. In fact, she's always short and I'm always long. And there are many days in which we offset each other.
Diversification.
Yes, that's diversification for you. But no, there's no way to know when a flash crash is going to occur. The problem that you have to be careful about is your exposure. So if you're overcommitted, in stocks, it's not so bad because, you have your money in the market. You're paying essentially full price. Most people are paying full price. If they're leveraged, they're paying half. It's not going to wipe them out in one day. Um, Futures are a problem because you're always leveraged, so you need to keep a large reserve. Most futures traders will trade no more than 40% of their investment. To leave that extra money for losses so that they can keep trading at the same level when they have a loss, and to absorb in an unexpected crash of this sort. Uh, and it should cover almost everything, especially if you're diversified. If you're diversified and one market crashes and it's 1/10 of what you're trading, then the impact of that is reduced by 10 times. So, so the effect won't be devastating, won't be good, but it won't be devastating on your account. You'll still be able to trade. And hopefully these flash crashes roar back uh, almost all the time.
So, would you say then your stop losses are not intraday active, they're active end of day?
I don't use stop losses. I don't like stops because invariably you get a horrible fill, uh, especially when the market's moving fast. They have no obligation to fill you on the way down because there's a void. You
Yeah.
need some, if you're trying to sell, you need people who are buying, and they just are not there. And so chances are you're not going to get filled to the mark until the market bottoms and starts trading. So I don't like that.
Okay.
Um, in general, in the tests that I've done, if I place stop losses, it depends on the market I'm trading. So if I'm in a noisy market, like the S&P or an index market is noisy, I might know where my stop is, but I won't get out until the end of the day because chances are, because it's a noisy market, the end of the day will be a better price than during the day.
Yeah.
For a market like Euro dollars, which is very trendy, I would want to get out right away because in a trendy market, when your stop is hit, it tends to continue in the same direction. So it all depends on the market. And and from that point of view, you should know which markets you're trading, whether they're noisy or trending. Because if you're a trend follower, you want to stick to the trending markets. And the markets that are not trending are silver, for example, the worst trending market I've ever seen. Probably the FTSE, uh, and the trending markets are dominated by the interest rates. And sometimes there's an equity market that squeezes in. The next biggest trending group would be foreign exchange, so that the euro and not the yen, but maybe the euro yen. And some of the currencies are very nice and trending. Uh, and after that, the stock market lags pretty far behind in the scale of trending. It trends in the long term. So if you're trading at 80, 100, or 120-day moving
Yeah.
average, you will make some money on it. If you try trading anything under 60 days, you will lose money in a
True.
trending
Yeah.
system. It's just too noisy. So you
Uh,
have to, you do better if you know which markets fit your systems. If you're doing short-term trading, you want to trade the noisy markets and you want to get in and then out on profit taking right away because you have no expectation of the market continuing in the same direction. So,
Yeah, that's a great point, which is to start development with the characteristics of the instrument you're developing for. Like, just don't blindly go and develop systems, because
yeah,
each market, just like you mentioned, some of them sits on the extreme of noise and some of them sits on the extreme of trending.
yes, if you can just remove, if you have a portfolio of stocks in your trend file, if you just remove the one that performs the worst, you will improve your results considerably. So you want to always stay with the markets that are doing the best on your system and get rid of the ones that are doing the worst on your system because the best ones have proved In a trend following system, they're trending. And in a short-term system, they're noisy and you can keep taking little profits out of them. So you want to look and keep track of the performance of each one of the markets you're trading and trade the ones that do the best. That's called persistence. It turns out that the ones that are doing the best are the ones most likely to continue to do the best. And that's the easiest way to develop your portfolio.
So you use momentum on systems, basically. Whichever is doing the best, you keep it in the portfolio and you kick out the ones that not, even if they are profitable, but they are not as profitable as the others.
Well, it depends how many choices you have. If they're all profitable, you do pick the best. My favorite portfolio only trades 10 stocks. And what I do is I run my trend system through 300, 400 stocks that have good liquidity. And I look to see how they've done in the last 40, 60, 80 days. And I rank them. And then I trade the 10 that have done the best because they tend to persist. Who would have thought that Tesla or Amazon or Apple would have just continued and continued and continued? Yeah. And if you sort them and they have the best stocks, those are the ones you want to trade, the ones that just keep going.
True. I just want to bring a really good story in your book, which regarding your wife being a floor trader, where I think in the crash 2008, you decided to get back into the system, you built positions, and then 3 days later, she's out.
Oh yeah, I can mention that. It's really true. A short-term trade, you have to recognize your own personality in trading. Either you like these long-term systems and you can deal with the risk and you're willing to hold the trade, or you can't stay with a trade. You're a short-term trader. You like to be in and out. You want to take profits as often as possible. So the way it went was we decided at a very good point in 2008 that the market was going to go up. We were going to take our investment capital and decide what we were going to trade and hold on to, like energy. Interest rates were going to, go up or down, but energy was going to increase. We picked a number of markets and we said, these markets are really good for the long term, and we're going to hold them for a year or so. And so my wife was in charge of implementing that. And she indicated that she had done it and placed all the investments in the right place. And then 3 days later, she says, okay, we're out. We made money. And that's because she's a short-term trader. I don't know that she's ever held a position for 3 days. And so even if you would like to do it, your own personality says that you have a comfortable way of trading, and that's the way you want to trade. So if you're a trend follower, you will hold a trade longer. Don't try to day trade. Yeah. And if you're a short-term trader, don't try to hold a trade for a long time. Doesn't work.
Yeah, so just like you mentioned, the system, some of them are trending, some of them are mirroring. Yes. Same thing for your own personalities. Some of us are short-term and some of,
So, yes. Stand in front of the mirror and ask yourself whether you're a trend follower or a short-term trader.
Okay. So I get this question most of the time. I'm sure you get it too, which is, okay, look, I want to trade. I want to get rich. How much should I expect? And the reality is, a drawdown is, at least from my perspective, is very correlated with the amount of money you should expect to make. So would you say if you're shooting, let's say, for 25% return per year, your drawdown, you should expect 25 or more? Is that a true statement, or do you think it's wrong?
It is a true statement. Yeah. I mean, look at the stock market. It has, what kind of returns does it have? If you're lucky, it has 10%.
Yeah.
Okay. Probably historically lower than that.
People look at last year of 30% and they think this is the normal stock
That's right.
market.
Not going to happen in the
Yeah,
long run. Um, what's the drawdown? In 2008, it was 50%.
yeah,
Um, you have to you have to look at that past data and be realistic about it.
yeah.
Um, I the market is not doing well now, but it's only down an average of 10%. Uh, it
Which
could,
is normal part of the S&P actually, if you
yes,
look at, yeah,
it's normal, but it could go down 20% and not be a problem.
yeah,
20% is also pretty common. So as a beginning trader, you really need to be realistic about it. You can't just bail out the minute it goes down 5%. Uh, you have to set your expectations, do your longer term test, see what the drawdowns are, how often they occurred. There are not too many drawdowns that stay below 20% for very long. That seems to be an interesting level. Maybe it's because that's a rule in the Dow that says a bear market's 20%. I'm not
yeah,
sure Dow actually said that, but somebody has made up that rule. And so more than 20%, maybe enough buyers start coming in and they hold the market at that level. But anyway, it the drawdowns are much bigger than you would expect, even if they don't come too often. If you're in this for the long term, you need to expect to experience these drawdowns and stay with them.
yeah. When we build systems, of course, the law of big numbers is a big thing, and we need a lot of trades to at least have confidence in the results. But unfortunately, especially if you're doing trend following, you don't get that luxury of getting many trades.
Right.
Uh, would you say that if we build, let's say, one system traded on many instruments, then we can collect all these trades as uh, like one system? Or maybe if we're trading one instrument, bring, let's say, five systems and combine all these trades. Like, are these workarounds are good enough or no?
They're not bad. I think the idea of um, using a system, for example, testing on different interest rates using the same parameters would give you a more robust solution. So, I mean, they are different. Euro dollars are different from 30-year bonds, but I, but I would still test your system on the 10-year note, the 30-year bond, maybe the 5-year, the Euro Bund, which is a 10-year, and a couple of other, and get some general parameters. This goes back to your first question about loose pants. You want you want the parameters that work best on all of these, especially because in trend following, you're right, you don't have as many trades. So you do get a more robust answer from testing across different different similar markets. I wouldn't say that you could do the same thing with the index market. Oh, you could do the same thing by testing different index markets, uh, but you won't get the same parameters for the interest rates and the index markets because index markets are much noisier.
Yeah,
So yes, you can get better results um, by testing similar markets in different countries and in the U.S. Um, I forgot the other part of
yeah.
your
So can we
question.
build multiple systems that trades one instrument and then treat all those trades as a
Ah, well, trading one instrument. Let's say you had a number of different S&P systems. You had a long-term trend following, and you had a short-term noise. It certainly gives you diversification, uh, and I have no problem with that. Um, a lot of traders like to uh, just concentrate on the S&P. It's very liquid, it's not an issue, but it's going to be hard to come up with profitable systems that do very different things in the same market. As I said, if the market's really noisy, you'll tend to want to trade some short-term mean reversion. And if the market's not noisy, you'll want to use trend following. The S&P is the only exception because in the long run, I mentioned there is some profits in trend following if you use 80, 100, 120 days. But in the short term, it's all mean reverting. So it's probably one of the few, or the index markets, probably one of the few groups you can apply short-term mean reversion and long-term trend. But most of the other stocks will only accommodate probably one type of strategy.
Yeah. Recently, I mean, past 10 years, Bitcoin came along, but recently we have more coins, let's say, that are liquid. And we only have currently two futures contract, one for Bitcoin, one for Ethereum. I know you're not trading this asset class yet. What would be the catalyst to include Bitcoin and futures contract as a diversification to your portfolio, if any, if you want to include it?
Yes, I think there is no catalyst. One of my problems with Bitcoin and cryptocurrencies in general is that there's no value. There's no intrinsic value. It's like a Ponzi scheme to me. It goes up because people want to buy it and down because people don't want to buy it. There's no arbitrage. There's no relating it to any kind of value. You could say the same thing for gold. Does gold really have a value? Why do people buy gold? Why is it at $2,000 or $1,800 an ounce? People use it for jewelry. It has a store of value that's perceived. But there are actual industrial uses for gold. Cryptocurrencies really don't have anything. And one of the issues that I see coming up is because Bitcoin was so popular, you now have dozens, if not hundreds, of these coins showing up on the market. That's going to dilute the effectiveness or the moves of all of them because investors are going to spread their money out and things. They're not going to be driving a particular one up as much as before because they can invest in other things. So, and I think there's a general problem about other stocks like Tesla. I think Tesla is wonderful, but the major auto companies all around the world are going to be coming out with electric cars. Even if they're not as good as Tesla, they will be diluting Tesla's ability to control the market.
Yeah.
And
True.
so there's going to be a limit to how high Tesla can go. Now, Elon Musk can go anywhere because he's so creative. He has all these other things coming. And I think SpaceX is remarkable and his tunneling and his batteries and all that stuff. So he's diversified himself. Tesla's important, but not as important to him. But I see this problem in Bitcoin or in cryptocurrencies that there's so much competition and none of the competition or none of the investors seem to be looking at what we call counterparty risk. People can hack into these things. The money can disappear. There could be errors in the accounting. These companies are not responsible for anything. If you lose your money, you lose your money. Don't bother suing anyone because there's no recourse.
True.
So not only do you have this competition coming in, which is going to affect the market, but I think it's a liability to trade. And because, as I said, it has no underlying value, no arbitrage, nothing like that, I'm never going to trade them.
Okay. Thank you for your honesty. You've been building systems for a while. I mean, at least 30 years.
A couple of years.
Would you, in the past decade, what changes did you make to your system, if any? And did you introduce new systems, kick out old systems? Just want to get your point of view of how often do you change your systems?
It's an interesting question. I don't think anybody's actually asked me that, but Um, when I started doing this in the early 1970s, we can count the decades on our fingers and see that that may be more than 20 years. Um, we traded futures only. And of course, the S&P didn't even exist. We traded agricultural products. There were no interest rates. Nobody cared about risk. We were able to make money. The markets were trending. That's when Donchen, if people remember way back, he was one of the originators of technical analysis. Donchen had his 10-day moving average, and a 10-day moving average worked. I defy anyone to make money using a 10-day moving average now. And the reason is that there was lower participation. People had the same opinion of the market, and it trended. And so it was easy. We made money, no problem. Nobody questioned risk. We didn't even bother. We no doubt overtraded, but we made money. 2008 was a big awakening. I mean, maybe NASDAQ in 2000, when it declined after the dot-com bubble, was a problem. But if you traded a simple moving average, you still would have gotten out of that 10 or 15% below the high and done very well compared to those people that held for a 90% decline.
Yeah.
But 2008 was the biggest awakening because we really didn't consider risk as much of a problem until then. And that really persisted. I mean, the decline, the drawdown lasted for 5 years, something like that. And so myself and everybody else started to figure out how can we do better controlling risk so this never happens again. And so our system.
So would you say you introduce controlling risk as a new change to your trading style or trading systems?
Well, first, I now use multiple parameters, multiple trends, when at one point I used only one trend. So I realized this concept of trying to get an average return, and an average return was the most realistic return you could expect. So that was a change, multiple parameters to indicate that that the system was more robust, more risk controls, including this extreme volatility, including some combination of drawdown and volatility to get me out of the market. Volatility stabilization, where I reduced my risk as the volatility went up. I increased my risk as the volatility went down. Those are all features that came in post 2008 because we got a kick in the pants from this risk.
So we build, especially in futures, there are tendencies to have seasonal patterns, biases, let's say, and some of them are really short. Like, I mean, I've tested oil where, for whatever reason, on Mondays, mostly it goes down. Would you say seasonal patterns, can you trade them alone first? And would you say they're a good diversifier to, like, for example, trend following or mean reverting?
Well, as I mentioned when I started in this, I was an expert in grains. I was a partner in a farming operation. And so I like seasonality. I think seasonality is true. In energy, there is a clear seasonality that during the summer months, the industry gears up for making heating oil for the winter. And during the winter months, it gears up for making gasoline for the summer. So there's a shift in which product is controlling the prices at that point. I do think there are some clear seasonal patterns. In agriculture, you plant in the spring and you harvest in the fall. So the low prices are consistently in the fall, unless there's some emergency, which happens once every 10 or 15 years, where some other country has a devastating crop production and we have to sell ours, and that raises our prices. Uh, but I wouldn't count on that happening. We also have in grains, we have crop scares sometime in the middle when there's a drought or too much rain or too something, and everybody thinks that we're going to wind up with no corn or no wheat or no soybeans. Uh, but it turns out we have a bumper crop because we have genetically engineered the seed for these things to survive almost everything. Uh, and we don't like to talk about it, but it's why we have such good crops, because this hybrid corn production has been fabulous. Unfortunately for the farmers, on a real basis, they get less and less money because they're producing bigger and bigger crops, and the price is going down and down while inflation is going up. So, if you were to look at the real return farmers are getting, it's lower now than it's been for the last 20 or 30 years. Anyway,
Yeah.
but that's my own.
Inflation alone eats up a lot of that.
Yeah, well, they're doing better this year than they have in some time. Corn prices are at $6, which is remarkably high. Usually it's at 3. So,
Yeah.
so they will make a bit more. But
Good for
anyway,
them.
for them, I like seasonality, but the seasonality in crops is that the price usually declines steadily from planting to harvest, despite the fact that there are some years where it runs up in the middle. So as a filter, it
For
turns
other
out
systems.
a system filter.
Yeah.
Yeah. So if I were to try to decide which trades I wanted in corn or wheat or soybeans, I would be taking only shorts.
Yeah.
So
Makes
because
a lot of
that's the
sense.
way it goes.
Yeah.
In and so I would bias just like this long-term trend. If you're a short-term trader, you still do better by having a long-term trend and trading only in the direction of long-term trend, even if you're a short-term trader. In the same way, if your market is seasonal, has a clear seasonal pattern, you should use that as your filter and trade in that direction only during those periods. And they're quite clear. And you
Correct.
can do this, you can do the same thing with stocks. There are a lot of seasonal stocks. Airlines, uh, retail stores have their biggest season in December.
Yeah.
Uh, Trading on the long side of that is bound to give you better results than getting caught on the short side at a period where 9 out of 10 years or 18 out of 20 years, the market goes up. So, so I do think seasonality is important, and it adds a different dimension to to your trading because it's not trend following.
Yeah.
It's a pattern that's based on something real. I like patterns based on real. Seasonality is real for commodities. In terms of the stocks, it's consumer patterns, and those consumer patterns tend to be incredibly consistent.
Yeah. You see that behavior actually in, like you said, in retail stocks, especially in Amazon. You can find really good patterns that
Not
very
Amazon.
consistent.
No, not
No?
not Amazon. Interesting. Amazon used to have that pattern, but they are so clever at having sales and Amazon days and this.
Yeah.
They
To
have
smooth out the curve.
That's right.
Yeah.
They have actually smoothed out their performance across the whole year by having all these special offers. They are very clever,
Yeah.
and they're looking at the same things we're looking at. So yes,
Data. It's all about data. Well, everybody else is a store. Amazon is like a data mining
oh, they
company.
are. Yes, they are high tech. But so yes, for most markets, especially uh, not entertainment, travel and leisure are extremely seasonal. Uh, the airlines. Now, I'm not sure how they You need to do your own studies or look at something I've done. I'm not sure whether or not they post their 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 sales when somebody uh,
buys the
buys a ticket, or
yeah.
they post it after they've actually used the ticket.
They're also
Uh,
trying to smooth out the
well,
sales
it's
cycle.
unearned income at the beginning. I
Yeah.
don't know if they can post it as sales until it's actually used. I'm not an accountant, so I don't
No.
know.
Me too.
But there is a clear pattern with airlines and hotels and other you know seasonal markets. How for sure the housing industry has a seasonal pattern.
Yeah, you can find like you said, you need to study the market to find out the seasonalities. But seasonality do exist in most of the markets, just like you mentioned, and it's worth adding it to a portfolio.
Oh, I think it is. Yes.
Yeah. If you want to put a beginner trader or even a professional trader, I'm sure because you have so much experience, what would you say the key concepts that you're gonna give this person to start their journey to end up profitably?
Well, I think that the two biggest um, points of advice I could give is start with trend following, long-term trend following with markets that trend. All right. It is the easiest strategy to understand and the one in which you will get an idea of what kind of profits and what kind of risks you'll experience. But to do that without causing undue anxiety, start as small as possible. You don't want to be trading a position so that if it goes the wrong way, you can't sleep at night. As a beginner, you will see the same patterns if you trade small. You could do that with stocks, of course, or a couple of one contract each of a few commodities, mostly interest rates, the euro, and of course you'll want to put the S&P in, even though it's may not be your ideal performer. But you can get diversification in futures with one of each of these markets, and you can even trade a micro if that's where your finances are. To get that experience, you want to have money in the market. Otherwise, you don't take it as serious as if you paper trade. You constantly try to outthink the market and think this wouldn't have happened to you if you had traded it just a little differently. So I would put money in the market as little as possible, trade something simple, and get that experience before you do more.
Excellent. Uh, for the people who want to get in touch with you, I'm going to show here. This is your personal website, Perry Kaufman. And then there is Kaufman Signals, where you have portfolios that people can follow with signals. I think you have three portfolios, if I'm correct. And obviously, your contact info is there.
Yes, yes, it's best to go to this website, Kaufman Signals, and send a message from there. I will respond personally, and I always respond quickly.
That is true. Thank you very much, Perry, for taking time to do this interview. I really do really appreciate it. And I hope to do it again soon after reading your new book.
Well, Ali, thank you very much. It's always a pleasure seeing you, and best of luck on everything.
Thanks. Thanks again.
Okay.